I actually did bring your checks today for the books, so keep forgetting that. So I have that for you, I guess at break time. We'll do that. And, very excited. We have a bunch of things coming up next week. We have two speakers coming in, both on special situation investing. One of the speakers is Dan Loeb, who is a fairly aggressive activist. We also have a gentleman, Matt Mark, from Gotham Capital, who is going to talk about a situation coming out of bankruptcy that he worked on a few years ago. It was really a great instructive model. He's spoken before, and he's really a brilliant investor. So we have two great speakers next week. You also have the first half of this class, my partner, Rob Goldstein. He's been with me since 8, 9, probably so 17 years. He's largely responsible for any of the success that we've been able to have at Gotham, and today he's been gracious enough to come in and willing to talk to us about how we decided that we could pay 21 times forward earnings for anything. So he'll be talking for the first part of the class, and please, if you have your name tapes out, most of you do, please help out and answer questions and participate in the talk. And we're very lucky that he came. I had to use my influence to get him here, and we're lucky to have Rob Goldstein.
Okay, so we came across Moody's in early 2000 when it was in the process of being spun off, and it was obvious that Moody's was one of the great businesses that we had ever seen, and the problem was it was trading at 21 times forward earnings and 24 times trailing earnings. So the question we had to ask ourselves was just how much of that greatness was already reflected in the stock price. Now, just to give a little perspective, typically at that time we would buy stocks at 10 times earnings and sell them at 14 or maybe even 15 times earnings if we got lucky. So the thought of paying up for a business like this was really a new thing for us. So what I did was I compared Moody's to Coke. Now, why did I compare Moody's to Coke? David?
Coke is one of the best franchises of any business.
Yes. And why else? Joe?
Because Coke was bought for not overly cheap price, and it continued over through its franchise to grow and make a lot of money.
Exactly. Okay. So several decades ago, Buffett figured out that if he identified a really great business, he could pay what seemed like a lot of money and still make a fortune. In 1988, Buffett bought $600 million of Coke stock. He paid around 13 times forward earnings, 15 times trailing earnings, and back then the value investing community didn't understand why that was any great bargain. But 12 years later, the $600 million was worth over $7 billion. So Coke became the classic example of paying up for a great business and making a fortune doing it. So that's why I looked at Coke. What was so great about Coke? In the back, I don't see.
High returns on invested capital, and you can grow the business without investing a lot of money in it.
Exactly right. What else?
one of the best, if not the best, brand names in the world.
Okay, true. And what else?
That high return on capital, you can grow it into areas with the same added return.
Right, okay.
In terms of the safety of the franchise, it's just a deadlock. I mean, 5 or 10 or 20 years, it's still going to have that competitive position.
Right, exactly. That's an important reason. Okay, so the 3 really good things about Coke. You can read my writing. Okay, so to sum up, those are the really 3 important things to remember about Coke. In addition, it was a relatively easy business to understand, and it was a predictable business, and most businesses are neither of those things. Now, Moody's was founded in the early 1900s, and revenue originally came from bond investors who paid Moody's for bond ratings. In 1970, the industry changed, and the ratings companies began to charge bond issuers as well as investors. This change was a huge deal for Moody's. The ratings agencies had gained so much clout with investors that debt issuers were forced to pay for their ratings or face significantly higher borrowing costs in the market. Today, Moody's and S&P each have roughly 40% market share, and typically most large issuers will get ratings from both companies because access to capital is very important. Okay, our first chart. Okay, so here we have Moody's historical financials. And in the 19 previous years to 2000, revenues had grown at a compounded annual rate of 15%, and operating profits had grown at a compounded annual rate of 17%. Not many companies have that kind of terrific performance. In the 19-year period, year-over-year revenue declined only 1 time, and that decline was just a few percent and happened after a period of rapid growth. So we know they've done great in the past, but does past success equal future success, and is Moody's a great business? How should we think about that? Joe?
How would what are the barriers to entry? It is a profitable business, could a competitor come in and start controlling the agency and take share away?
And do you think it could?
I don't think it would be easy at all, just because it's very. It probably could, but I don't think it would be in the short term.
Right. Actually, it's a very important question, and I don't think it is actually possible because, if a company set up shop and actually paid companies instead of companies paying them, I doubt that the managements of companies would want to waste their time even speaking to a third credit rating agency. Just imagine the CEO of IBM sitting down with, or the CFO of IBM sitting down with, Joe Schmo credit ratings to make $50,000 or $100,000 for his company. It's just not going to happen. So really, no matter what you did, I think it's impossible to start another business. In addition, you'd need to have the confidence of the financial markets, and you're not going to get that. It's just a chicken or egg thing, and at this point, you've sort of got two credible guys, and it's just not going to happen. It's, the odds of that happening are basically zero. So that's how I thought about that question at the time.
I agree with you. I was using the bond market for a while. What about Fitch? Aren't they trying to get into this? Are they owned by one of these other guys?
Fitch is independent, and they have a small market share, and they specialize in various little niches, but they're not the primary thing. And when financings are done, really guys want to have ratings from Moody's and S&P. I mean, to sell a deal, that's what you need.
Did you guys also look at Fitch and say, well, maybe this niche could be profitable niche as well? Were they not big enough?
You mean, did we think about investing in Fitch?
Yeah.
We didn't.
The
I think
market shares are really 40% for each of Moody's and S&P, and the rest of the market is 20%. Fitch bought the company that we looked at at the beginning of the year, Gotham Phelps, so they combined. So they're a big chunk of that other 20%.
Is Fitch public now?
I don't know.
I'm not sure that they are, but I don't know.
How did you think about regulatory risks from the standpoint of either you're obviously making huge amounts of profits,
Right.
Which could cause the government to force entry based on antitrust or break it up or do something?
Well, it's interesting because that would be a risk. However, nobody likes the fact that there's really two guys dictating credit ratings, especially companies. But it's just one of those things where what could they do about it? There's absolutely nothing they could do about it.
Or
And it's not. I don't think anyone thinks they're making too much money. I think they just might want to see more. There's an anti-competitive lawsuit of some kind filed against Moody's years back.
Well, what about the cozy relationship argument as it may relate to Enron or someone else? And all of a sudden the government says, look, these guys aren't really doing their job. They just have a relationship with these companies and are getting paid out. So therefore, we're going to mandate that you have to have ratings from 3 issuers or 4.
Okay. Well, let me just say that that's just one example, but you've left out the 20,000 times they've gotten it right. Nobody bats 1,000. Having said that, if you could think of a solution, then something might happen. But from a practical point of view, there is no solution. No solution I've ever heard of, unless you have something.
No,
Yeah.
I'm not lodging a complaint, but the government's acted irrationally before based on investor
Right.
hunts, et cetera.
Well, they have, but here, there's just no alternative. So that really keeps that situation from.
I think also you're messing with financial markets that work pretty well. So it's a lot to stick your nose into at this point. But you're right. Anything could happen. But then you can say that about anything. Any investment you ever have.
Goldman Sachs could go into the business, but they'd have to give up their other business, and obviously that wouldn't be worth it.
Actually, Duffy Phelps was in both businesses, money management and ratings, and they had to split up.
Gina.
What's the page what year you make a choice?
We looked at this in early 2000s. So this is a good question. This is what I was looking at in early 2000. And this came from some company, something or other, some statistical thing. Anybody have any other thoughts about anybody know why the company did so well over this period of time? David.
Sure. As soon as growth in the financial, the debt issuance markets combined with them now taking fees from the companies.
It was from both of those things. Yes.
The one to Matt's point earlier, the one thing I could see potentially happening is a bunch of banks getting together and starting an agency. Although the bank doesn't agree on anything. So.
Right, but why would they do that?
Just because they don't like having to deal with only two credit rating agencies. It would be relatively easy for them to
Right, but
start.
the amount of money that would cost. First of all, they have conflicts, so nobody would care about their ratings necessarily. In addition, the amount of money it might cost them to do that might not be worth the benefits they would gain. And I think that would probably be the answer.
Related to that,
Matt.
what are the economics on the bond issues at this point, issuance? So let's say a company issues $500 million. What does Moody's collect from the company, and how is that structured?
That's a good question, and I don't know all the specifics, but what they do is they charge companies, in general, they will charge you some kind of an ongoing fee to have a relationship, and they'll charge you, I don't know, some minuscule amount of basis points. You know,
There's not a lot of incentive for people to want to eliminate this.
it's tiny. It's really tiny in the grand scheme of things. Yeah. I mean, their revenues are not that large considering that they rate, literally trillions of dollars of securities.
I think also the issue is brand name. You say the same thing about Coke. You can make the fizzy stuff and the color and copy it. And there's other drink companies that could possibly do it and that do it. But there's a value to the brand. Moody's and S&P have the brand at this
Right.
point. So
Right.
there's a value.
Right.
to that.
But to your question, their fees are not really excessive in the sense that it would really incent somebody else to try to come in and do this. So, okay. Just to explain where this growth came from, because it's important for the rest of the analysis. 30 years ago, when you'd get a loan, the lending institution would retain that loan. Today, many of these loans are securitized and sold into the capital markets. The guy originating the loan is not necessarily the guy financing the loan now. Today, there's trillions of dollars of these securities, including credit card loans, home equity loans, commercial mortgage loans, auto loans, etc. And to do these securitizations, you need ratings. Financing loans through the capital markets is more efficient than the old way, so one would expect that the growth would continue. In addition, Europe was way behind the U.S. in terms of their growth curve of issuing these asset-backed securities, and Asia was behind Europe. They were just sort of starting to go down that path. So basically, there was lots of growth ahead. We talked about good return on capital, which we can get to later. And in terms of the lasting competitive advantage, we talked about why there can be no new entrants. And I guess, we sort of touched on why there won't be any pricing pressure, which is because, their fees seem reasonable in the larger scope of things. And you really have to go to S&P and Moody's to get ratings. So, and they both know that. So they're not going to be very negotiable on fees. So the company was in the right place at the right time, and the same factors responsible for the past growth would be expected to continue into the future. So we concluded that Moody's was a great business. Oh, sorry. Okay, so let's go through the split up. In December of 1999, Dun & Bradstreet announced that it was going to split into two publicly traded entities. Investors would get 1 share of Moody's Corp. And 1/2 a share of D&B Corp. Moody's Corp. in, I think March 1 is the date I used, was trading at $27.75 a share. We were going to get 1/2 a share of D&B Corp. And, you know, we did the work on D&B Corp. It was hard to analyze, but we assumed we could get at least $15 a share for our stock, which meant that we could get $7.50 a share for our half share.
Yeah, the bottom line was that it was very complicated to figure out, so we just used very low price.
So we figured we'd be paying no more than 20.25 for each share of Moody's. At the time, I expected Moody's to earn 95 cents a share in 2000, pro forma for its new capital structure. And what that means is the parent stuck $200 million of debt onto Moody's so that we had to subtract out that interest expense. Okay. Okay, this is a price chart of Coke. And so, how much did Berkshire Hathaway make over those 12 years? We'll assume that he paid $5 a share on 6/30/88. 12 years later, his stock was $58 a share. Be right around here. And he had collected $4.75 in dividends over that time. And just to keep it simple, let's assume he was able to earn 6% on those dividends that he received. So let's value the dividends at $6. So his $5 turned into $64, and he's got a 23.7% rate of return on his investment, annualized. Okay, so I basically pulled these numbers right out of I think an annual report at the time. And the question is, why did Buffett do so well on his Coke investment? Anybody want to take a shot at that? that means I will. Oh.
Price increases?
They,
Case volume was up less than the industry. Revenues were up more.
More up, more than industry. More than industry.
well, it's interesting. Over the 10-year period, that's
Oh, I
correct.
thought that was industry on the right. Oh, it's fine.
No, you're correct. Over the 10-year period, revenues were up 8.8%, and unit case volume was up 7%. Oh, that is industry.
But yeah, it's,
I
guess
think
price
they got.
increases.
I think they got. Oh no, the industry is 4 to 5%.
Yeah.
The industry is 4 to 5%. So over the 10-year period, they got some price increases. Of course, their costs also went up. They were able to grow their unit case volume 7% a year, so they had organic growth. They didn't need that much of it. That translated to 12% operating income growth. There was a little bit of leverage, so they got 13% net income growth. And they bought back stock, so they got 15% EPS growth over that time. The other reason why he did so well was because, and we just talked about this, he only had to reinvest 20% of the earnings back into the business. So that meant that in addition to the buybacks, he was able to pay out dividends. Now, just one formula I'm going to put up on the board because we're going to come back to it later is growth rate over reinvestment rate. Equals ROE. So their growth rate was. Does anybody want to take a crack at what their ROE was? The growth rate was 12%. Reinvestment rate was 0.2. So the return on equity was 60%. Is that right? Yeah, that's right. Okay, so that's how the business performed. And in addition, he did so well because there was big PE expansion. He paid about 15 times forward earnings when he bought the stock. And in 2000, when we looked at it, it was trading at, north of 30 times expected 12-month earnings. So, how can we expect Moody's to perform for us over the next 12 years? What growth rate should we assume? Anybody? Todd.
Go back and look at, try to break up that historical growth into price versus volume, and just how much new issuance versus how much are they jacking up the price every year, and then have a view on where you think debt issuance growth is going to be, and maybe assume they can then continue to increase prices at the same rate they have historically. But I don't know whether debt issuance would be more or less. That would be something that we need to consider.
Right. Well, given the story we laid out with this whole disintermediation thing going on, and the fact that you would expect that to continue because it's a more efficient way of doing things, and then you had Europe and you had Asia, you would expect those numbers to go up. You didn't know how much they'd go up, but they ought to go up. And how else would you think about it?
$60, I think, is the answer. You'll know what the answer is above 60. I mean, the growth rate target 12 and the investment rate is less than 20%. The ratio is going to be at least 50, if not more.
I'm sorry, say that again?
I mean, the numbers don't really know the answer, but you know it's going to be at least 60 because the growth rate's higher and the drawback
What's
rate-
at least 60?
The ROE.
Right, but my question is, what would we expect for growth going forward, not ROE?
I think if you assume 12 or 10, which I think is a safe estimate, the results going to be pretty good. So the exact number you don't know, but it's going to be
Okay,
safe
that's a
estimate.
good point. That's a good point. But you still had to pick a number. It's a very good point.
Like 10, 12.
It didn't really matter, is what you're saying, and that's true. Well, we settled on 12%, and the reason why we settled on 12% is because one, management guidance was low single digits. And two, because 12% seemed very reasonable considering the historical operating performance had been so much better, and the belief that the same factors responsible for the past growth were going to continue. Now, anytime you try to evaluate a business for the first time, you need to make these types of key valuation assumptions, and part of the learning process is to hear management's financial expectations for the business, and especially their reasoning behind those expectations. Usually, you'll conclude that management's rosy outlook is based on some shaky assumptions that you wouldn't want to bet on, but occasionally there will be some obvious reasons why a company is very likely to meet those bullish expectations, and that was the situation at Moody's. So we felt very comfortable that they could grow at very healthy rates in the future. Now, an estimated 12% operating earnings growth rate for Moody's happened to be very convenient because that was Koch's growth rate during those 10 years we looked at. And so for the remaining analysis, I could now just focus exclusively on the difference in return on capital and how that impacted the different valuations. What would you guess Moody's return on capital was? Anyway, a lot higher than Koch's, true. Why?
They don't require the physical tangible capital requirements.
Okay, that's exactly right. Their return on capital was infinite because they had no, they had $50 million in PP&E. They needed, desks and computers for 2,000 employees, and that was it. In addition, their customers paid on time or in advance. They were in a very strong position. They could demand payment up front. And you typically see that kind of a thing with companies that earn good returns on capital. But the answer was their returns on capital were infinite. Very few businesses like that. So Koch needed to spend 20% of its earnings on So Coke would spend $1, they'd reinvest 20 cents, and you'd have 80 cents left over. Moody's would spend nothing, and they'd have $1 left over. So how much more was Moody's earnings stream worth than Coke's? 25%? Okay. $1 is 25% greater than 80. I mean, $1 is 25% more than 80 cents. Now, does this mean that the higher return on capital makes Moody's worth 25% more than Coke? Well, yes and no.
Well, I don't know the exact way, but it's compounding, so that over time it's going to, depending on what you do with capital, it's going to have a pretty big difference.
All right, but leave that capital use out for now.
So what's the exact question?
The question is, everything else staying the same, does this fact that Moody's has a higher return on capital mean that their business is worth 25% more than Coke?
Their dollar in earnings worth 25% more than Coke's dollar.
Yeah, in terms of free cash flow, yes.
Okay. Well, in the short term, that's correct, but in the longer term, you know, they're not going to grow at these 12% rates forever. And so if you assume in the very long run that growth rates drop to 5%, then if you go back to this formula, you see that for Coke, 0.05 over 0.6 will mean that they need to reinvest 8 to 10% of their money in the business, 8 to 10% of their earnings as their growth rate drops.
Everyone following that?
Okay. This formula here is what we use to calculate the 60% ROE for Coke. Now, growth rate over return on capital equals the reinvestment rate. The growth rate at some point in the future drops to 5%, you know, 20 years down the road, whenever. The return on equity is 60% for Coke, we calculated. So that means the reinvestment rate would be, you know, 8.3%. The slower the growth, the less capital you need, the more capital you can pay out. So, let's just assume that at some point Coke will be paying out, you know, 90 or 92% of its earnings. So we kind of just split the difference and said, let's assume that this return on capital thing is going to mean that Moody's is worth 15% more than Coke.
What was that other calculation we have?
It's just somewhere in the middle between 25 and 10 or 8. Yes?
That's the profit besides the Coke. First is management change. The second is that he can find the potential of great volume growth. So when you look at Moody's, can you see same thing?
So management and volume growth.
Yeah.
Well, we just talked about the volume growth. And as far as good management, we didn't discuss that yet. But, you know, a management that for this many years has run a business this well is probably going to keep doing a good job, is kind of how you look at that. And when you spoke to them, I mean, they just thought about things very clearly, which was no surprise. I mean, when you see performance like this, you know somebody's doing something very well. I mean, for most guys, it would be hard to maintain this return on equity. They'd find some way to screw it up. So I think we felt very comfortable with management.
Isn't it hard to see a track record though for capital allocation when it's been under the parent company? And you don't know how they're going to. You assume.
Well, it's a very good question, but
more rational coming
all that growth had been organic in the past. And so your question is, now that this guy is new and can do what he wants to do, is he going to screw things up? And, well, you know, when you talk to management, you can get a very good sense, which I did, as to how they think about things. And, you know, talking about how you're going to invest future earnings is something that managements tend to be very, you know, there's lots of things that they don't like to talk about, but that's something that they're usually very open to talking about, and you can really get a very good sense if there's some risk as to their taking money and squandering it. When you spoke to management, they were very much, they clearly understood the accretive benefits of share buybacks. I mean, that's what they talked about. They understood the math. They understood that their business had huge growth ahead. They didn't need to do anything else to do very well in the future. So, you know, their incentive to do something, you know, it's just really taken away. I mean, you just have no reason to go out and waste your time trying to build a better mousetrap when you already have the best one. So, you know, it just seemed that, I was going to get to that later, but I'll talk about it now, but it just seemed like there was really zero shot at management destroying value that way. In addition, you know, Buffett happened to own, I think, 10% of the company. And, you know, you'd ask management, do you speak to the guy? Does he, you know, talk to you about these things? And they'd say, yeah, he spoke to us about that. And you know, I mean, they respect his opinion. And you could really get to, I think we would have gotten there anyway. But, I mean, if the chance were 2% that they might do something stupid, the chance dropped to 0% that they were going to do something stupid. So that's how we looked at that.
How much of their compensation was in stock options?
I don't remember, but I do remember that the incentives were, you know, typically you'll look at how much they get paid versus, you know, in compensation versus how much they'll get paid if the stock goes up. And, you know, you like to see sort of, if the stock doubles, they'll get paid 10 times what, you know, they'll get paid in a year if, you know, they just collect their salary and bonuses and that sort of thing. And I don't remember exactly what their comp structure was, but it was in the realm of not a problem. It was sort of what you wanted to see.
Yeah, I guess I bring it up because
That's a good question.
Like this, where you're asking about a really intelligent management. Well, if they're really smart, they'd just be, you know, defer cash payment for, you know, forget it. You know, they know if they're really smart and they know what they've got, they'll just be not just leaning toward that way, but they'll just be all the way at the extreme because they know they'll get really rich.
You mean they'll lie about?
No, I just mean you'd expect them, if your case checks out, kind of the ultimate check is these guys aren't just kind of leaning toward getting stock and stock options. They'll just be saying, they'll be way to the extreme, saying pay us in long-term options, basically. Does that make sense?
Yeah, but, you know, it's not everybody's like that. I mean, these are older guys. I think that, you know, some of these guys, I guess, weren't older guys. They got families. They need money. You know, there's a board that's involved with making these decisions. You know, not everybody thinks exactly the same way about these things. So, you know, although if you were in this situation, you'd say, pay me less and give me more stock options. Somebody else might not say that, but regardless, I think the balance was, you know, in the good category. And typically these spin-offs are. Not always, but, you know, 85% of the time, I think. Okay, so you just raised my next point, which was, is there something else we need to consider? What are they going to do with the money? So, you know, we saw that Coke returned all their excess capital, and we felt that Moody's was very likely to return all their excess capital. In fact, they were going to put more of that money into buybacks because that's what management had said they were going to do. So we basically took this important point, and we could leave it out of our analysis at this point because they were basically going to be equal for both companies. So can we justify 21 times earnings? So here we 13 times 1.15, the benefits from the higher return on capital. So you can pay 15 times earnings and get the same thing. How about 21 times earnings? What?
What's the 13 times 1.5?
Okay. We concluded that because Moody's had a much higher return on capital, their business was worth 15% more.
A dollar in earnings was worth 15% more than a dollar in earnings.
13 is the PE of Coke.
13 was the PE of Coke in 1988.
The forward PE.
So you could justify a PE of 15, but you're saying...
Based on the higher return on capital, we saw that we were
Now
going
what
to
would
use
justify
similar revenue growth assumptions. You know, growth rate was the same, ROE was different, and let's assume this was the same. Amar.
Was the interest rate environment different at the time, so maybe you could justify a higher multiple depending on what the risk-free rate was?
Yes, and I'm going to get to that in a minute. Okay, well, the analysis I made was, actually that's a better analysis than the analysis I made, but I said what would have happened if back in '88 Buffett paid 18 times earnings, or $7 a share, for his stock. And so what would have happened is he still would have done great. He would have made 8 times his money, and he would have had a compounded annual return of 20%. Still a great purchase. So he could have paid 18 times earnings at that point and still have done great. So times 1.4 equals, you know, $5 to $7. You increase the price by 40%. Gets you your 21 multiple. That's what we had to get to. Which is why we used 1.4. Does that make sense to people? Or? Okay. Okay. Well, let's say you went back to 1988 and you said that he couldn't pay 13 times earnings. He had to pay 18 times earnings. How would he have done on his investment? And he still would have done great. So basically, he did so well that he had so much room that he could have paid a lot more for his stock and still had a very good investment. Not as good, but still very good. He would have made 20% a year, each year, over those 12 years. And that 40% number got us to our 21 multiple. So we kind of backed into it that way. And that was the original analysis, and the reasoning was very sound despite the shortcut we used. But actually, the first time I spoke in Joel's class, one of the students, like you, said, didn't interest rates have something to do with this? And immediately I knew that interest rates had a lot to do with it, only I never really thought about it. So what happened was, after Buffett purchased Coke, interest rates over the remaining 12 years dropped from 9% to 6%. I do have a chart, actually. Oh, and I have handouts, which I didn't hand out yet. So, back here, 9%, and over here, down to 6%. So if you priced a 30-year bond and said that that 30-year bond, how would that change in price if rates went from 9% to 6%? The answer would be it would go up by 42%. If it was a perpetuity, it would go up by 50%. But it's not. It's a 30-year bond, so it would go up by 42%. And so, that's the right way of really looking at things. And so, just so happens that, and this was somewhat random, but the 42% is basically the 40% that we came up with right here. Does that?
That's the tailwind that Buffett got on this investment.
Yes.
But if you're looking at Moody's out 10 years, now interest rates are low, but who's to say?
Okay, well, let's see how Buffett would have done. If that's a very good question, actually. And let's see how he would have done. Okay, so if interest rates drop from 9% to 6%, things are worth 40% more. If rates go up, they're worth, the way the math works, they're worth 30% less. So going from 1 to 1.4, up 40, from 1.4 down to 1, 30% less. So let's say that had his stock traded for 30% less at the time we did this analysis, he would have had a $40.60 stock. He would have gotten $6 in dividends. He'd have 46.6 over his original original $5 investment. So he would have made over 8 times his money. And I did the math, so I know that's a compounded annual return of 20%. And that's still, it's not as good as the 23.7, but it's still very good. So, taking your point, it wasn't that we were expecting to do 23.7%. We were assuming that, well, if interest rates stayed the same or went down, we could expect to make 20%. And that's probably what he was looking at when he bought Coke. I don't think he was betting on lower interest rates, although who knows what he was doing. That makes sense, right? Okay. Okay, so following from that point, would we expect Moody's to go up 20% a year for each of the next 10 years? All right, well, I have another chart. Okay. let's see what happened right after he bought Coke. Let's see what happened to the stock price, so that we can maybe use that as a guide as to what would happen at Moody's. So in the first, assuming that he bought his stock on June 30th of '88, and I didn't use $5, I used the actual price on June 30th of '88. 1 year out, he would have made 50% on his money. In years 2 and 3, that number would have compounded by 38% each of those 2 years. And in years 3 through 12, he would have made about 18% a year. So, the important point here is that the stock traded up 185% in the first 3 years, and that you get the higher rates of return in the early years. If stocks are valued sort of fairly, just for assumption's sake now, let's say stocks should return 10% if things are fairly valued. It's not always the case, but let's just make that assumption. Then you would expect that a security shouldn't exist priced so that it could return 20% a year for 10 years, given that all the other securities are priced to pay you out 10% a year in the future. And when guys, it's like with any spin-off, when guys wake up, things kind of tend to get priced fairly relative to the rest of the world. So now for the good part, what happened to Moody's? Well, there's a good part and a bad part. The good part is that it did trade up. In October, when this stock was actually spun off, it was up 20% from where it was in March. And by that following April, so I guess that had been just over a year, the stock was up 50% from where it had started. Now, what happened with Moody's is, and here's the sad part, because we sold our stock too early on this one, but in what happened was in 2001, the business exploded to the upside, and profits didn't grow at 12%, they grew at 40%. And then the next year, they didn't grow at 12%, they grew at 35%. And so profits have compounded over the, following 6+ years at 25%, at least 25%. So, I guess that's what happens when you use conservative assumptions. But, the stock is up, 6 or 7 times since then. And, a lot of those gains, came early before earnings really took off. So.
So how did you decide on what price to sell? You look at...
That's a very good question, and we obviously made a bad decision. But, it went up a bunch. Earnings hadn't, started to, shoot up yet. We've got higher hurdle rates than, a guy managing, zillions of dollars. So we, the stock was up 50%. We had to think seriously about, selling and, putting, our money into something else. Now, when you make these analyses, hindsight is 20/20, and it's just everything is so easy in retrospect. But in real time, when you're doing this, you're obviously worried that, well, stock's now 30 times earnings. What happens if I'm wrong? What happens if I don't know, things do poorly next year, and all of a sudden you're not paying 30 times earnings, you're paying 40 times earnings, and now the business looks shaky. So, it's never as easy, at the time as it is after the fact. But we sold when it was up, 50 or more %.
We did learn something from selling it, that maybe that was the wrong decision. When we have one of the top 5 businesses of all time in our portfolio at any point, we may think 3 or 4 more times next time we have one and we were able to buy it well.
And it's also possible that management, understated their, growth targets for this thing. I mean, they have a sense as to what new products are coming out. I mean, they really have a better handle on their business. I mean, you really can't get. This is a very big picture bet. You really can't get. Some businesses you can understand the nitty gritty a little bit better, but you really couldn't here. And so we just kind of took a big picture bet, and that's kind of just the way it worked out. So.
Anybody else?
Come on.
Sure. Given how fast Moody's has grown, was it sort of 6 times it's been off, does that justify a sort of stock price? Do you ever guys go back and look at that? Just to see, if it's growing at 40, 35, whatever percentage is that, the stock price would actually justify it at this point?
No, it's too painful, and it doesn't matter.
If you want like straightforward, honest answers, Rob's the guy. All right, but thanks. That was great, Rob. Really good. Okay. We're going to take 15 minutes. We're done at 12 today, so make sure you're back in 15 minutes. I have checks for those, I promise. Anyone?
Are we missing anybody? Okay. I was looking through the schedule for the rest of the year, and I didn't really see a space to talk about the little book, and figured, you guys have a lot of chance to beat me up, ask questions that you wish you could have while you were reading it, or at least reading the appendix and things of that nature. And so I had put together, let me just put this on, and also the main question I usually get, and we can go through this, and it's probably the most important question, is why the hell did you write that book? Because, gee, this works pretty well, and so hopefully part of what we talk about today, and you can ask questions, why I'm not too worried. So I put this together. I was going to show you another slide thing that I did last year, but I think this actually combines a lot of ideas. This is a talk I'm giving next week called The Bull Market and Time Arbitrage. And time arbitrage, I think, is a term that Bill Miller coined to describe what he does, which is really, I guess, take a longer-term horizon on things and wait for time to close the gap between what he sees and what the market sees. I'm hoping this works. So this was the simple value formula, a little bit different than just buying low PE stocks or low price to book. It was what we talked about all semester, which is buying good companies, and we define those as just companies that can earn a high return on capital. Of course, what we did in the book was look at last year's earnings, just because no one could really argue that much about them. They could probably still argue about them, but probably not that much, not much debate about what the operating earnings of the company were last year. Obviously, as a value investor, we would, there's a lot of problems with looking at last year's earnings. Like next year, they might not earn that. or many years in the future. It could be aberrational. It could be a cyclical peak. Could be a lot of problems with looking at just last year's earnings to decide whether something is in a good business. Just because they earned a high, an oil company returned a high return on capital last year doesn't mean that that is the return on capital we're going to use going forward. I think more importantly, and what I think you should remember about using that also is that that's, even if it is a good number, it's historical. In other words, it's just one indicator. In other words, really why you're looking at a high, you want to know what kind of company, what kind of business you're in. Obviously, if it earned an 80% return on capital versus 10% return on capital and you figured that was somewhat normal, then you might say that's in a better business. But it may not matter quite as much if the business can't expand anymore. So in other words, looking at historical return on capital is helpful if your incremental returns on capital have some relation to whatever your historical ones were. But this assumption was that we used last year's earnings and that we were hoping that had some relationship to what they would look like in the future and what earnings would look like in the future and what returns on capital would look like in the future. Same thing, cheap stocks. This is just a better way to look at PE. Remember, we took into account EV, enterprise value, and looked at operating income relative to enterprise value. What the operating earnings are important just because that's what the business earns. How much money does the business earn? And then how you capitalize it is a whole different story. So this is a better way to look at it and look at sort of apples to apples rather than apples to oranges with firms with different tax rates and different leverage ratios and things of that nature. So very straightforward that we talked about all semester. And these were the results of 30 stock portfolios, roughly 30 stock portfolios that basically were held, each stock was held for a year in this. And that didn't, how do I get that on the screen? There we go. I don't know if you can see it. When we looked at the top 3,500 stock universe, historically, I think we had certain trading rules that, in other words, a stock had to trade a certain amount to make this list and things of that nature. Owning a portfolio, and the way that the Magic Formula stocks, that group of 30 stocks, earned 30.2% on average during the 17 years that appeared in the book. Actually, I guess this particular chart added 2005, so whatever it is, versus 11.9% for the equally weighted average of the universe, and versus the 12% for the S&P 500. So that was pretty good. The way this was calculated really is you had you owned stocks from January 88 to January 89, and we calculated the returns from the portfolio during that period, and then from February 88 to February 89, you had a different return and like that. And so we had an average of 30 stocks in the portfolio, and each stock was held for a year and just sold. So that's pretty good, right? No need to come to the rest of the class because that's pretty darn good. And we were impressed as well that it worked so well. But then you could say a lot of things about this. I first got involved in doing any of this really back at Wharton. I did a study of Ben Graham's net nets, which was really just a balance sheet oriented thing of finding stocks that appear to be trading below liquidation value. And at the time, we really we didn't have either money or availability really of databases like we have now. And so we actually took the Standard & Poor's stock guides that came out every month. They still publish them. I don't know who looks at them, but they still publish these things. And we had them in the library, and we took out, I think, 8 years' worth every month. They had 5,000 companies, and we went through them and figured out what the liquidating value was. And it's a big part of the project. And then my friend Rich Bazzina, who I did the study with at the time, he was pretty good at computers even then. and he went over to the what was a digital equipment 10, a DEC 10 machine, which was about 3 times the size, bless you, about 3 times the size of this room. And he figured out how to stick all that data in there and, figure out that, gee, it did, still worked. And so that was pretty exciting because we were always looking for this, which was a sort of magic formula not to work for the rest of our lives and make a lot of money. And of course, we get out of school, the bull market of the 80s sort of erases, the early 80s, starting in 82, whatever, pretty quickly erased all the, what they called nets, the stocks trading below liquidation value that we had done the study on. But it sort of got us into the value world, and so it still worked out well, but didn't have a magic formula for a long time. And always thought we had something back in the 70s and disappeared. So it was nice to see these results. And this is really how we look at companies. We look at companies, what kind of company is it? Is it good? Which we talked about a lot. And one of the things we'll look at is return on capital. It's not the only thing, and it's not determinative. And more importantly, we try to figure out what normal earnings are a few years out. And that would be much more valuable than whatever we do here if we were good at predicting that. But this is a lot easier, and there's no debate about it. Yes?
If you look at different industries, which industry the magic formula is a better predictor for than others?
It's a very good question. We have looked and are looking at lots of different things, and what we shared in the book was sort of, we thought, generous. So yes, we did we did leave out financials and anything that didn't make sense from an EV to EBIT analysis, just to keep things simple. We probably left out 20% of the stocks, 20% of the market, insurance companies, banks, other kinds of financials, just to keep it simple. And I would imagine that that there are metrics for those, but not these, and that wasn't the simple thing to do, and this is actually what we did. And like I said, we didn't, when we did the study, we didn't cherry pick, let's see what'll work, and run the model, data mine, really, and run it 50 times, see what would work. This was the very first test we made, because this is these are the 2 most important things we look at. How cheap is it, and how good is the business that you're buying? And the philosophy was, if you can buy above average businesses at below average prices, on average, that should work. It's not any more complicated than that. Obviously, we can make it more complicated by using normal earnings, and that's the whole art, and having security that your estimates are good. But a lot of these companies, you could argue, were very small. So we decided to just look at the largest 1,000 companies. Generally, market cap's $1 billion and over in today's dollars, at least, and even higher. And it's still, the bottom thing here shows up 22.8% doing the same thing versus 11.6% for the equally weighted universe that we chose from, and 12% for the S&P during the same period. And you can notice that through most of the periods, besides obviously this 2002 down 25%, so there's an obvious problem, although the market was down 22% that year. We beat the market pretty handily in most years. I think there were 2 or 3 years that we didn't, so it looks pretty good. Yeah.
It looks like in this case, the formula didn't beat the market, it performed much well.
Show me what year you're looking at.
2002.
Well, it didn't do much worse. I mean, it did 2.6% worse. 93, yeah, 93. It underperformed, definitely.
So just comparing
Right.
that versus the prior slide, you look at the yields, you look at what wasn't at it.
Yeah, we had, I mean, it's basically, you're still picking 30 stock portfolios, but one you're picking out of 3,500 stocks, one you're picking out of 1,000. So if you're getting to pick out of 3 times more stocks and you're picking the same amount of stocks, you would guess that you would find cheaper and better or more outliers or however you want to, on average, you know, and the penalty over time was, I can't discuss, I mean, I can't describe why one particular year did better than the other, but over time it, did 7.5% better, annualized, which is a lot of money. Yeah.
Close every year. I mean, did it help the companies change, or were there companies that consistently stayed in that group?
There was a decent amount of turnover, pretty much turnover. I think I wrote in the book it was 1,500 companies during the course, were held during the, at some point during the study. I don't remember the exact number, but it was a huge amount of companies, that it wasn't just, 1 or 2 companies hitting. Let me just get this thing. So that's a reasonable question, but there were tons of companies and a lot of turnover because you're only picking 30 out of 1,000 or thousands, yes.
Are we done?
No, yeah, go ahead.
Oh, related to that, what was the, did you look?
You want me to be done? Is that what
No. Will you stop? Related to that, what did you look at the industry concentration of that portfolio versus whatever market average or S&P? Because I imagine it would be a lot more concentrated.
Yeah, it was more concentrated, certainly at various times. Whatever industries are out of favor would generally be much more, whatever looks like it would be a problem are much more heavily weighted here. Probably also, you'd probably have an outweight of brand name, companies that earn high returns on capital. So you wouldn't have that many steel companies in here during the time. You'd have, maybe brand name companies and service companies and some consumer-related companies that, have brands. Yeah, John.
Did you look at how the performance in any given year was distributed across the 30 names? Or were any generalizations to be made about that? Was it very concentrated, or was it broad-based?
Didn't look at it close enough to answer that question. I guess, we had a lot of consumer exposure during the whole period, I think. Is that right?
We had a lot of consumer discretionary exposure during some months.
Right.
And, a lot of the stocks did well, and a lot of the stocks didn't do well. Outperformance-wise.
But, we have another slide coming up which, probably answers, should answer some of the skeptics anyway. Amar, did you have something?
Yeah, I was just wondering, did you ever think about looking at the starting point, like maybe a protracted bear market, like the 70 or something like that?
Well, what we did here was we used a database called the point-in-time database from CompuStat, and it only went back this far. Is the main reason. There was no scientific reason why we went back this far. I guess it was the most recent period also, which was nice to have. You sort of needed very good data also, so you could go back earlier, but it wouldn't be nearly as good data, and you get a lot of noise in here. We did take some time trying to clean up the database, even this database, to make it usable, because sometimes when you just get numbers, they're all over the place, and especially if you're picking a pile of outliers, you'll get a lot of bad stuff if you don't really know what you're looking at. So the further you go back, the less I would think it's reliable. But, we can, good question. We would have liked to go back 40 years. Pardon me? Right. Oh, that's a good point. Rob just points out there were 2 bear markets during the period. 1990 period was pretty tough. If you look at the S&P was down, dropped 50% from, so I would call that a bear market. 2000 to 2003 kind of dropped 50%, and that doesn't happen all that often. 1974 was the last time it dropped that precipitously. This was a weird one, but it's always weird when it drops 50%. Something's weird going on. Yeah.
Can you talk about the distribution of the returns among the 30 stocks in the portfolio, in the sense that, was it that one stock in the portfolio gave you this average performance that year, or because they're outliers. So maybe like 5 of them did really poorly, and then 1 of them tripled.
Oh, well, I would say, and we didn't look at it that closely statistically, but I would say that because you're looking at last year's numbers, okay, you had your share of losers, and you had some stocks that were actually doing what you did, good companies that were way out of favor, that you could buy very cheap, that did tremendously well. So you had a combination of those two, especially in the 30 stocks, and that's why maybe the next slide's helpful. Yeah.
As I recall, I don't think there was one stock that more than tripled in the large cap thing.
Okay.
Because there's a 12-month holding period, and these are large cap companies.
Okay, so I guess there were no 10-for-1s here, unfortunately, or fortunately, however you want to look at it.
So
But
actually, so in the sense that if you wanted to implement something like this, would you be able to hold on to these stocks if 8 of them lost 50% and 1 of them made you that profit?
well, what I described for people in the book, because I assume the difference between you guys and who I wrote the book for, although it was supposed to go both ways, was that what we've been describing all semester, which is figure out what a company's worth and pay a lot less for it. That's all we're trying to do, right? And 99+% of the people can't figure out what a company's worth. So that's why we said you have to own a portfolio of 30 stocks, because on average you'll be buying above average companies at below average prices, but individually 8 stocks will definitely not do well. And maybe 8 will do really well and the rest will just do average, and this is what the average looked like. But hard to argue with this slide, which is going by decile, taking the top decile of companies as ranked by the magic formula and putting them in group 1, and then putting the second best rated rank of stocks, the second best group of 10%, in decile 2, third in decile 3, and this is pretty cool that decile 10 decile 1 beats decile 2, beats decile 3, 4, 5, 6, 7, 8, 9, 10. So it's, that's not just 30 stocks. We just divided the universe here by deciles, I think this was a 2,500 stock universe we used here. So 250 stocks in this decile, 250 here, 250 here, 250 here, and over time, it clearly kind of works, and this one works really well. The disparity between decile 1 and 10, depending on which run you run, some of these might get muddled, but there's obviously, you can see the chart, very tough to say it's just 30 stocks. It's a lot of stuff. Dave?
How did the bottom 30 stocks perform? Not just the bottom decile, or did you not?
We didn't run the bottom 30. It's a good question, but I'd imagine badly. Yeah.
Just curious, did you run the same decile breakdown on the 1,000 stock universe, and did you see something similar?
Yeah, all of them were similar. I did pick, see, a few of these middle things get muddled, like this one, but they were all almost exactly the same as this. Like if this 14.2 got switched with this 14.1, so I did choose this one because this one was exact, to be honest. But they were if I showed you the chart, they would all be identical. It didn't matter which group I did; they would be identical, other than maybe these 2 things might have been swapped in 1 or 2 of them. So I just picked a big broad, and also I thought to do a smaller group, not as as opposed to 250 stocks in each one, is a little more compelling. There, yeah.
Did you guys look at perhaps a risk measure for these categories?
Pardon me?
I know we don't look at volatility in this class, but were these high returns because we were taking on more risk?
Well, it's a good question. It depends which, I think, portfolio looked at, but it wasn't explained anywhere. Volatility was not much different, right, than the market?
It wasn't.
We did look at it, despite the fact that because I figured other people would want us to look at it.
Well, it depends how you
also define risk if you want to look at risk leverage of the underlying stocks. This was it was less leverage than the market as a whole.
So you would imagine companies that earn high returns on capital would probably need less leverage to whatever. Well, there are a few things I went through in the book, criticisms that people would have of this. And one was, we went through the whole thing with, the 3,500 stock portfolio. Oh, some of the stocks are too small. You really can't execute. You can't buy enough of them. Institutions can't follow it. So that's why we did the top 1,000 stocks. That worked pretty darn well also, and tough to argue with. But people would say, gee, a lot of studies are flawed because you had look-ahead bias. The data that you were using at the time was basically not available at the time that, at that real-time period. And we used a database called the point-in-time database where that wasn't the case, where whatever CompuStat's customers had on that date, that's what was in that database. That was the actual database that the CompuStat customer had, and that's the database we used. So it's called look-ahead bias. We didn't have any of that. We didn't have the earnings before we had them or anything like that yet.
And to the extent where if there's press releases, that is the earnings number that they had in the database.
In other words, this point-in-time database was simply some guy who kept his disks that he received on X date, okay? And the database was reconstructed as if you were a customer of CompuStat and you had what you had on that date. Whatever was in the database, you test on that date, that's what you would have received back. So it's exactly what the customer had on that date, take into account whatever S&P did at that time. Okay? So there's no, it's exactly what you could have done had you had that been a customer. Then there's a thing called survivorship bias that, a lot of databases have where, well, if the company went bankrupt, we just strip it from our database, or, something changed or whatever it is. This, once again, was the point-in-time database, which is the exact thing that they had, so nothing was stripped from it. We talked about very small companies that you couldn't buy. That's why we did the 1,000 top companies. Then another problem is, where we've seen all the models of low PE, low price book, all these things. They say, well, yeah, but after transaction costs and all that stuff of rebalancing your portfolio, you didn't make enough difference to pay for that. That's usually been the rub of against doing, low price book or low PE or whatever it is. And these disparities were huge here. 10 points or more. Here's the one that we talked about. They say, well, yeah, you beat the market, but these stocks were riskier. There was a famous FAMA French study done, I think, in the early 90s, and they decided that there were some elements like small stocks and low price to book stocks, okay, outperform the market, and with less volatility, actually. And these were efficient market guys, and they said that in that particular case, so they did the study that showed that that worked, and then they concluded that there's a risk that is not being picked up by volatility, even though that's what we use, but there's a risk that's not being picked up by volatility because these companies are at low price book, they are more likely to go bankrupt, there's some business risk that's not being picked up, and that's why they're really priced correctly. They're riskier stocks, they're small, they're low price book, so they're more likely to go bankrupt and they're lose their earnings or whatever it might be. And they really are riskier, but it's not quantifiable in the volatility. That was their conclusion, basically, that there's a risk that we don't see. Now, the two-factor model, we're picking companies earning good money that earn very high returns on capital. So, that really very difficult to pin that on this one, even though they found, and I think erroneously concluded, that they were riskier companies for some reason that we can't quantify, and the market really is efficient. Yeah, Matt, let me just get Matt first. Yeah.
Related to that, one of the things that control for was economic performance. And over the study period that you looked at, the economy's been performing generally well. I would think in a poor economic environment, returns on capital, high return on capital businesses wouldn't have the same advantage to the extent that they usually can compound, or you see greater effects of compounded growth in high returns on capital. And then also you have...
I missed that point.
So as the company grows and it has high returns on capital, you have a greater compounding effect versus businesses that don't have high returns on capital. So therefore, the economic performance, the strong economic performance we've had, would bias those versus if we don't going forward. You know what I mean?
Okay, and which companies would bad economic performance favor going forward?
Well, it wouldn't favor high returns on capital as much as in a strong economic performance. And then also you have very little, if let's say we have very poor economic performance, you have very little asset floor value oftentimes in high returns on capital business, because usually there's very little capital.
Right. Well, I mean, just looking here, this was as close to a good recession, you know, besides here, okay, where we did pretty darn well. We had a little recession here after 9/11, and the returns were pretty good here. In 90 also, while the average stock was down 16% and the S&P was down 3%, we did a little better. We did obviously much better in 91. So it didn't show up there. Let's just go to the next. Yeah, we did a tiny bit worse there and a lot better here. So the question is, if you have a constantly terrible economy, I'd still rather be in a better business, so I'm not really clear if that would hold, but I see you make the point. I think it's still tough to argue with this during that period, and I think it's I'd still rather own a good business than a business that's not earning any money in good times, I guess. Eduardo, did you have something? Okay. Yeah.
Well, I mean, even if the companies were riskier in the sense that there's more volatility to the potential outcomes for the companies, why should you care if you have a portfolio of 30 stocks?
Why should you care if it's more volatile, the portfolio,
If
versus
any-
the market?
If any, no, not the portfolio. If any one of the companies was more volatile in the outcomes, would it, in a portfolio of 30 stocks, most of that?
No, what I was talking about, the volatility was for the portfolio. If you put together a portfolio of these versus the market, which is riskier based on volatility, and the answer is this was not. Okay? Done.
How are the factors applied to actually set these deciles? So like how do you put in the earnings yield and the return on capital to determine what the top decile actually is?
Oh, well, basically, I described in the book, but what it is if you have 2,500 companies, you rank them from 1 to 2,500 on return on capital, and then 1 to 2,500 based on cheapness, you know, EV to EBIT, and then you just add it up. So if you had a company that was if you had the company that ranked 1 over here in return on capital, but number 1,100 in cheapness, then you'd get a score of 1101. If you had something that was 200th in return on capital and 200th on cheapness, it would get a score of 400 and be ranked higher. Then we ranked all companies based on those two rankings and you know, put them into deciles, and that's all that happened. Who did I get so far? Josh?
Did you play around with weightings after sticking?
This was what we published was the first thing we did, which was let's make them roughly equal.
Have you ever run the formula using 3 or 5 year historic average EBIT instead of last 12 months? Because, I don't know, maybe it would give you a better quick and dirt estimate of what normalized earnings would be.
Well, what we published was what we did first, which was just like look at last year and you know, trailing effective PE and return on capital, and that's what we did. There's a lot of smart things to do. I think that's the impressive part. We didn't do any of them. We did something stupidly simple, not really trying very hard, and let's just see what happens to this. And these are the results. There's many, many flaws in what we did. There's many, many better things to do, most likely. But I think it's pretty spectacular that with just looking at what happened last year, that you could decide ahead of time like how a group of companies is going to perform. I'll say that again, right? Isn't it good to know how much money you're going to make before you invest? I think it's good. So, Joe.
Have you ever committed any of the capital that you guys managed using like under this formula?
Similar formula, yeah. But we also, most of our money, it depends. What your skill set is. Like I said, 99% of people don't know how to value companies. We use the principles from this formula, so we'll take normalized earnings several years out on the few businesses that we think we're good at predicting what they are, and if we can buy them at attractive prices, we would rather do this. But we have more slides to come, and you'll see why this is, I'm making it sound really easy to do. And these are the results. I'm not arguing that even. But you might see why this will, by the time we're done, why maybe this is a little harder than I'm showing you to actually accomplish in real time. Anybody else? Because we have more. Yeah.
Did you run the formula for the 1,000 smallest companies in the database?
In other words, did we take the bottom 1,000 of, let's say, the 3,500? So we just did number 2,500 to 3,500. Did we do that? I don't think we did, and I don't know that. We're always picking from a bigger group. That may do better, and then it's a question of execution also for us. But like I said, there's probably 100 things that make more sense than doing this, or improvements that you can make on this. And I'm just sort of pointing out, we divided 50-50, we did some stupid ranking thing, we looked at last year's earnings, and this is what happened. So it says, I think we're on the right track anyway. Next book. No, I don't think that's going to be in the next book. But all right, and then there are other criticism. I guess the only last one. And then they criticize these things based on data mining, saying, hey, you tried 80 different variables, and you went in all these different periods, and you just picked the two that worked the best. And obviously, I said these are the first two we tried because this is how we invest. This is how we look. So that wouldn't be. And then we use knowledge from other market-beating studies that was not available at the time the stock purchases were made, and we really didn't do that. Like I said, what we did, I knew low PE stocks were, for instance, so I knew to look for companies that I could buy earnings cheap on. But I don't think that really used too many studies. This, I guess, is a slight, pretty much the same thing, I guess, just extended through the first half of 2006. Pretty similar results, using pretty much the same top 1,000 universe of companies, roughly, during the period. Might be the top 1,200 companies for this one. So that's the equally weighted index, 11.5% versus 22.6 here, I guess, for the 18 years. Here's some more interesting statistics, just this stupid, simple thing that we did. Following the strategy, we underperformed the market 41% of the time over 1 month periods. And over a 3 month period, we underperformed 36% of the time, 6 month periods, 25% of the time. And this is against the equally weighted universe. 1 year periods, 20% of the time, 2 year periods, 15% of the time, and 3 year periods, we beat the market 3 year rolling periods during this 18 years that we did, which is, probably a couple hundred rolling 3 year periods. Beat the market 91% of the time, or only underperformed 9% of the time. So fairly compelling. This in the red is the times that we underperformed over rolling 3-year periods. All these green bars are the times we outperformed the universe. So compelling, I think, sort of showing that. All right, so this is for 3-year periods, following the strategy for 3 years at a time from, let's say, January 88 to January 91, from February 88 to February 91. So rolling 3-year periods, so we got a couple hundred. The value strategy was up 99% of the time. It was actually 99.5, and actually, when it was down, this is the only period it was down 0.7%. So really, it was flatter up the whole time. The universe, equally weighted universe, was up 89% of the time. The value strategy outperformed 91% of the time. We just saw that slide. And these are the worst returns for a 3-year period for our strategy. It was flattish. It was the worst return, 3-year return. So you never lost money, basically, following this thing. For the equally weighted universe, it was down, the worst period was down 42%. So, you could look at volatility and all this other stuff, but just by an equally weighted universe, if you have a bunch of negative returns like that, what's the way to measure risk? You might say, I would say, this sounds less risky, perhaps, or at least certainly during the period that we studied, it sounded less risky, right? This is versus the S&P. 45 underperformed the S&P by 45% in 1-month periods, 27% in 6-month periods, 22% over 1-year periods. So we outperformed the S&P 78% of 1-year periods looked at. This is the 30 stock portfolio. The 3-year periods outperformed the S&P 93% of the time. Only 7% underperformed. 14 out of 187 periods. Excuse me. And that's what that looks like versus the S&P. The little red is the times you underperformed. Everything in green is outperformed. So summarizing, this is against the S&P. Value strategy is up 99% of the time. S&P up 83% of the time. Value strategy over 3-year periods beat the S&P by 93%. Value was basically flat, the worst return for value. S&P was down 40% too, not just the equally weighted index as their worst return during that time. So once again, looks pretty good relative to the S&P. You might say, gee, those are the wrong metrics to use, something. Oh, well, let me go to this. And this is the main point, even though it's only on one little slide. So I just showed you all these great metrics, right? 99%. This was down 40%. This is the times we underperformed the index. These are all the times that we outperformed. Incredibly compelling. But now we get to this slide. Let's look at non-overlapping 3-year periods, or non-overlapping periods of underperformance. So we have our value strategy, or our magic formula strategy, that you saw all the statistics. It looked amazingly good, right? And this is against the universe, the equally weighted universe. Okay? And we killed them, right? We crushed that. And we got double their returns and a lot of other good stuff. Yet, there was a period during this 18 years of 46 months, so almost 4 years where we underperformed. Okay? Then, if we want to look for the second longest period that we underperformed that was not overlapping with this 46 months, there was a period of 39 months that we underperformed. So that's 4 years and 3 years and change. So that's 7 years out of, so we were like in business, let's say, doing the magic formula thing, right? And for 17 or 18 years, and for 7+ years of that time, were underperforming a simple index. If you want, let me just see for a second. This is the S&P versus the S&P, depending if you want to look at another metric. So 3.5 years here and another 3 years. So for 6.5 years during that period, even though we doubled their returns, and even though the 90-something% of 3-year periods we beat it, there were still 6.5, during 6.5 of those years, we underperformed. Yeah, Matt. Dave.
Is that 3-year periods or months?
The 42 months. So in other words, there was a 42-month period where we underperformed.
For each month you underperformed? For 42 straight months? Or
No, this is from start to finish. I do have those statistics, and that would probably, they would add up instead of to 6.5 years to about 6 years. For the bottom two, if you had to underperform for each month, if you were still behind in rolling periods. Okay? But pretty much the same results would be. In other words,
So the right way to look at that 36-month period is just one 3-year period? 36, the second longest period?
second longest period is from start. Yes, it would be 1 3-year period, but what I'm saying is these are non-overlapping. So basically, during that time, you were underperforming the index for the S&P by 6.5 years, if you want to use a more representative index, over 7 years. And the question is, when you do that for a while and you're in business, you're starting to say a lot of stuff. You're starting to say, like, gee, you know, this hasn't worked in the last 4 years. Right? I mean, you know, it hasn't worked in the last 4 or 3 years. And that happened twice during a period where you're looking backwards in a period that we know the statistics, that it did incredibly, incredibly well during the whole period. Right? Doubled the return. We had so many instances where we did so much better. Yeah, Joe.
I'm assuming one of those periods was the end of the 90s into 2000 when you guys performed?
You know, I have this. It's a good question. I have the stats, but basically it depends what I'm comparing to. One ended in 95, actually, and one, you know, not the end of 90.
I'm just curious, do you ever compare...
These are non-overlapping, so it's huge periods.
But I mean, do you ever compare the actual, the universe correction at the end of that period? You know, meaning that, like, if we
look at the whole period, it certainly corrected because we doubled the return during the entire period. So yes, of course. What I'm trying to point out is you can't hope to do better in the future than we did in the past with this thing. This was a phenomenally great period. We saw it. We outperformed in all these different things. Yet, still, we had to live through this period where if I'm in business and I'm doing I'm putting all my money into this thing and it hasn't worked in 3 years, or, you know, I haven't beaten even a simple index.
Did you ever look at transaction fees for and returns net of transaction fees for the portfolio? Because I would imagine that you would incur, starting from scratch every year, would incur significant fees.
You know, we didn't, although that's why we did the top 1,000 companies, which are pretty very low transaction costs is the answer. I mean, it doesn't affect much. In the smaller companies, it may. You know, you may have to subtract 2 or 3% of the return over time for the smallest companies, but then, you know, you would have beaten the market by 28% versus 12 instead of 31. For the larger companies, very low transaction fees, well under 1%. Yeah.
Slide where there's a chill in the room and they say, this is why I can't do this in my shop.
I don't know. I'll let you know next week. I just wrote this. You know, I just did this investigation. I mean, I knew why it's tough to do, because even if anytime you underperform for a couple of years, you know, I mean, the speech I'm going to give next week really is going to be, and why I called it the bull market and time arbitrage, is really to give you the big picture is, as the world has gotten more institutionalized, basically, you have to give your monthly, even if you're in a hedge fund where you don't even tell them what you have, you have to show up with monthly returns every month. And if you show up 1 month, not a good return relative to other people, 2 months, 3 months, okay, so you had a bad quarter, okay, we'll live with that. You know, 4 months, 5 months, 6 months, all right, you had a bad 6 months, you know, we're long-term investors. 7 months, 8 months, 9 months, the year goes by, you had a crummy year, you didn't outperform anybody, you didn't outperform the index or whatever it might be. So they say, we'll give you another year. So 2 years are up, you still stunk, okay? Then they say, you know what, we got to watch this guy, very closely, and by the end of the first or second quarter of the third year that you're underperforming either everyone else or the benchmark index that you're looking at, they ask for their money back if they're really patient. They ask for their money back. And here, there was almost a 4-year period and over a 3-year period, non-overlapping during this phenomenal record of success where, and one institutional manager said, well, who should I give my money to? Should I give the guy with the lousy record or the guy with the good record? You're not going to, even this phenomenal long-term strategy failed during this period. Jay?
What is it, like how many years back were you researching all of these underperformances?
No, this is just the 18 years. So just the thing I showed you in the beginning,
Okay.
during the 18 years. So during 2 non-overlapping periods of 4 and over 3 years, so 7 years during those 18 years, I was underperforming, even though the results were pretty phenomenal. Let me just whip through these because you might say, oh, you used the wrong benchmark. Because everyone, like if you sit in an institutional investment meeting, and I've done my share of those, basically you're looking at all the managers and, the guys who stand out are the guys who didn't do well last quarter or the guys who didn't, forget about the professionals who are managing the portfolio. When you go for your quarterly meeting or whatever, you're looking at the list of guys who have done well and who haven't done well. And then after quarter after quarter after quarter after quarter, you're underperforming. So what they do is they benchmark. They say, well, how's he doing relative to, other people of his ilk? So we picked roughly 1,000 companies, which is the Russell 1000, the 1,000 largest companies. This is a Russell 1000 value, assuming people would categorize you as a value investor. Okay? So you just compared. You can see that we did 10 points better than the value and pretty much double the overall thing, the overall Russell 1000 total return. And you can see once again versus the total return of 3-year periods, the strategy beat it 93% of the time of rolling 3-year periods. Pretty impressive. Underperformance in red, outperformance in green during those 3-year periods. Pretty impressive. Once again, versus total return, up 99% of the time. Russell 1000 was only up 83% of the time. Our worst return was flat, basically. The Russell 1000 total return was down 41% as worst return. So pretty impressive. You say, that's not the right metric. Let's go to the Russell 1000 value. Let's see how you did there. So you beat value over 3-year periods. You beat it in 1-year periods. You beat it almost 80% of the time. In 3-year periods, you beat it almost 90% of the time. And that's the graphic representation of that. And then you see once again, I guess the Russell 1000 value did better. Was up 90% of the time versus 99%. But our worst return was flat again, and this was down, 19, 20%. So, versus the Russell 1000 trailing, we killed that one. Yet, 46 months again, and 36 months we underperformed, non-overlapping periods. And against Russell value, which did a little better, it did a point better over the time, there was 53 months that we, 4.5 years we underperformed, and then 3 change years. So 8 years during that 18-year period, we were sucking wind, losing our customers, during these periods. So you can't expect better results than this, where you're doubling the market's return, that you're beating it in 90+% of 3-year periods. Yet you do have these periods, non-overlapping periods. A large part of your life is spent not doing well following this. So the question was, do we put our money, do we do this, or would we put all our money into this? And the answer is probably not. Probably not, because let's say, an idiot writes a book and says, this thing really works, right? And you should just go do this. What's going to happen after, 6 months or a year or 2 years of underperformance. You're going to say, hey, everyone's doing it, or it doesn't work anymore, whatever that might be. And that's what most people would say. And even we, who think it should work, would probably put a portion of our money, or have put a portion of our money, doing something similar to this. But, so you don't have to quit your day job, we would rather understand the companies we're investing in, that we're buying them a lot cheaper and than what they're worth, and we feel more confident putting our money in that than this, because we're going to go through this 53-month period and this 39-month period, and it makes sense to buy, and it always makes sense, and it'll always work. And so that's why it was called the bull market and time arbitrage, meaning buying above average companies at below average prices works. It's always going to work. It always makes sense on average. It's going to work over long periods of time. But there are long periods where it might not look like it's working. And even in something where we look backwards and we couldn't have done better. We really just couldn't have done better than this. You can't expect to do better than doubling the market's return with a lot less risk, winning in all. We won in so many periods. We beat it 80% of the time in one-year periods, yet went through this string during that time, where the types of stocks that we were picking were not doing better than the market. Jay?
The beauty of this formula is its simplicity. And to your knowledge, are there any other investors or followers of the market who have put out, two metrics, something as simple as this, to try to use as a benchmark for stock picking in a performing market?
Does someone else put up another two?
No, I mean, are there any other maybe competing magic formulas out there in the world? That
well, there are a lot of quants out there who I think I wrote in the book and it got I don't know if any of you read that appendix part, but compared it to Bob Haugen's work, where he had I think 65 factors that he looked at and created, and so we compared this to that, and the way we compared it is we don't have his 65 factors. We know what the top maybe 10 are or something like that because he published those. But what we did was on his website for over 10 years he published the rankings. Didn't say how he got to the rankings, but he published the rankings of the stocks in the database that he was using. So it was very easy to say which stocks ranked in his top decile, which in the second, because we had the actual rankings, whatever he did with those 65 factors. And so we said, let's rank his companies by decile, based on his rankings, and let's rank them like we did over here by our decile. And so we looked at his top decile. Oh, and what we did was each decile we held for a year, okay? And his factors were, he put together his factors to say what's going to be the outperformance for the next month for these stocks, and buy those. Those are going to have the best outperformance. But a real portfolio manager, or say if you're really buying cheap stocks, should hold up for, should be able to buy a stock and hold it for a year and see how it does. So that's what we did to his 65 factors. We said, your top 10%, hold them for a year. How did they do? Our top 10%, hold them for a year. So, let's see. All right, so over the 10-plus year period that we tested, his universe was up 9.38%. The best ranked decile, actually, okay, this is even more fun. Okay, so the first thing we said is, if you turned over his top decile every month, okay? You just swapped the top decile for this month, the next month you pick whatever stocks were in the new top decile, because he would re-rank every month. Then the market averaged 9.38%, and his 71 factor model, it says here, is 22.98%, so it did pretty darn well. The lowest ranked stocks, the bottom decile, lost 6.91%, and the top decile, like we said, did 22.98%, so almost a spread of 30% between top and bottom if you turned over his stuff monthly. The magic formula with 2 factors instead of 71, if we just turned them over monthly, were up 24%. The worst ranked stocks lost 7.9%, so a spread of 32%. So we did a little better there. But now, what if you held his portfolio for a year? Every month you bought his top decile, held it for a year. The next month you bought his decile, held it for a year, and then did that for over 10 years. It says, and it must be right because it's written down here, right? 71 factor model, the market still averaged 9.38%. The best ranked decile returned 12.55%, and the worst returned 6.92%. So a spread of 5.6% between best and worst. Still had predictive power, was still valuable. The magic formula, though, the best ranked decile did 18.43%, and the worst decile did 1.49%, so a spread of 17%. So the 2 factors create a spread of 17%. The deciles held for a year. And during the same period, we used the same exact universe he used too. His did 5.63%. So other guys do this stuff, but this is the most powerful 2 factors that we've seen published anywhere. These were 71 that Howard used. Anybody else? So what do you think? We just did this study. I sort of intuitively knew. It wasn't that in depth of a study, but we sort of intuitively knew there would be periods where this didn't work, and you know that. But living through it and looking at the statistics over 17 years makes it seem very easy. But to live through 2 non-overlapping periods of 4.5 years and 3 years and change during that 18 years, tough to do. Yeah.
Well, it's bad, but I'm sure in that 53-month period, there's plenty of months where you are outperforming.
Right. Well, I did this for a speech, actually, and that's a good point. In other words, what if you were being it for 48 of these months, then you just did so terribly in the last 5 months, and that's how you got to the 53 months. And I did this, because it's a little more compelling, but if I did it just cumulative, in other words, you were behind the whole period, this would say 46, and this would say 36.
Yeah, but 53
so it's the same thing.
53 months is 30% of the period. And if you looked at 3-year periods, you only underperformed for 12% of the period. So the reason being is because that's only 20 some months or 17 months more than the 36-year period. So it's only.
But let's think about it practically, okay? And this is my point. If you're in business and someone has their money with you and you have underperformed for 4 years, you're done. That's what happens. And that's why this is hard to do. And, most guys aren't this good. So even if you're good, in other words, let's give me the presumption that what we're doing here makes sense, and the guy who is running this model or actually picks stocks this way, who can double the market over a 17 or 18-year period, and he's doing smart things, things that make sense. He's buying above average companies at below average prices, and he's consistently doing that, whether he's valuing them or whether he's following this model or whatever it is. He's doing smart things. And looking backwards, we know it was smart because he doubled the returns and he had less loss and, all these kind of things. Looking backwards, the guy had some talent, right? Looking backwards anyway, he had some talent. And even the guy with talent is going to face periods like this, okay? And it makes it very hard to do professionally. It makes it a hard business to really stick with your guns. You can see that it's much easier if you just mirror the image. You mirror the why people would want to mirror some index or benchmark, not go too far above and not go too far behind. It's you don't get killed. It's like the analyst who how analysts' estimates usually bunch up near one particular area. If you were an outlier and you're way too high, okay, you get into much more trouble. You may be the only guy right, and that's good. But if you are wrong and everyone else was right, you're basically risking your job every time you put in estimate like that. So you're better off bunching, either way too low or way too high. You're an outlier. You're much safer being with everybody else because everyone was wrong. So you don't lose your job. If you want to be the outlier, you're taking some risks, and by following a strategy like this, you're the outlier. You're pretty much always the outlier. You're buying out of favor companies, things that people don't want, and they zig and zag at different times than any benchmark that we tried to find. And it's very hard to do in practice. And so I think that's the good news. That's the bull market in time arbitrage, that if we buy companies, and most people are looking to do well, they don't want to buy it because it's going to take 2 years to turn around. Most guys won't buy that company. Following there's a bull market and following a strategy like this is a bull. It's not going to go away. This opportunity is not going to go away because people are going to suffer severely, even during wonderful periods for the model. Okay, for the magic formula, people are going to suffer, and the same thing goes for picking individual stocks. That what Bill Miller does, which is it's worth this. What, the next 2 years are really going to stink, or it's going to take 2 years for people to see this thing play out all the way, or until they earn money, or whatever it might be. Tough to live through that, and most people don't choose to do that. And so I think, the big question that everyone asks is, there's so many hedge funds, there's so much money chasing this, and the question I'd ask if I were you is, gee, did I miss the party, right? Used to be easy, now it's really hard because everyone's doing this, and I think this will always save you. Yes?
So, would you want to add more, one factor of how long the stock was overlooked?
Pardon me?
So you underperformed the market for a long time. So if you add a factor, how long the stock was overlooked, you may pick the stock more better.
Okay, you mean if a stock has underperformed for 3 years,
Yeah.
how does it well? Well, they've done all kinds of studies showing, like momentum studies showing, if it's done well in the last year, that's really good. That's a good momentum factor. If it's done well over 5 years, it's negative. Okay, so the stocks you want, stocks that haven't done well in the last year, market price wise, they've done studies that show next year's, on average, won't be good either. Okay, in other words, negative momentum is bad in the short term. But if a stock hasn't done well for 5 years, that's a good signal. All right, for 1 year it's a bad signal. For 5 years it's a good signal. So that's sort of saying that. If I were constructing a model, I would probably choose not to use too many momentum factors. One, because I don't necessarily trust them. Two, you can make all this very complicated, and what we keep getting back to this year is figure out what the company's worth and paying a lot less. And it's not more complicated than that. And when you turn it into a stock rather than evaluating a business, you get away from what makes sense. So even though it's a tough business to be in, doing logical stuff that makes a lot of sense, you probably should cut out the rest of the junk because this did result in doubling the market's return. This kind of strategy. So.
Do you have any idea what the cumulative returns look like at the very end of those 53 months?
You mean, were you still ahead, from, let's say this ended in 95, from 88, were you ahead for the 7 years?
Yeah.
I would imagine you are, because then it would have been a longer period. If you were still behind for the 7 years, it would have said 84 months. Yeah.
Did you look at what the returns on the portfolios were in the prior year? I'm assuming since it's cheaper stocks, they're probably negative or lower than the market.
Okay, meaning the type of stocks that we pick from the magic formula, the question is, how'd they do the year before? Were we picking stuff? We didn't look at that. But like I said, we've looked at lots of stuff. We haven't looked at lots of stuff. And the point of this exercise really was to say, gee, this is what I've been teaching for a lot of years. This is what we've been doing for a lot of years. Do these two principles make a lot of sense? They intuitively made a lot of sense. We're not quants with 71 factors figuring out all these things, but it would be kind of cool to compare just logic and what we actually practice to what happens when you turn into a quant and think it's a piece of paper and it bounces around, and how did it do the last 3 months bouncing around wise, and should that affect what I pay? And I'm saying, I don't want to look at that. That doesn't make any sense to me, and maybe it works and maybe it doesn't, but I just want to say I'm buying a piece of a company. I'm buying my share of the company, and if I can buy that company cheap, I'm going to make money over the long run. And I'm right. I'm going to make money over the long run. And so, you know, I would much prefer to put my money in a model like this because it just consistently makes sense statistically. What I'm doing makes a lot of sense to me than a model that has 71 factors that, you know, include, you know, 47 momentum things and, you know, all kinds of things that don't seem to me in the long run to make any sense. They may work, but they'll probably work in the short term, right? We saw that how well they worked for 1 month, and then it totally broke down. Not totally, but you know, almost totally broke down, holding them just for a year. So, you know, did they really make sense, or am I playing a game that may or may not continue? And so that's, you know, that's the way we look at the quant world, a little bit different. Anything else? Last question? Go ahead.
Yeah, during the 53-month period, how bad did it get as far as the magnitude of underperformance? And can you talk about, you said there were 2 periods, one that ended around 95. When did the other period end?
I said 95 because that's the one I remembered. Those are excellent questions, and I will look. I think depending on which index I was looking at, obviously the beginning of 2000 was a rotten period for us because the 3 prior years the world was kind of crazy. So those were bad for logical things. But I was surprised to see that the end of 95 was one of the other ones, just because that was a long period of time to not do well. So, and the fact that these are non-overlapping is like, you know, you sort of, if this ended the end of I don't know what the answer was, but if this ended in 95 and this ended in the beginning of 2000, so I had like 53 months, I'm a total you know, I ended 95, I'm a total loser. I have 2 good years, and then I'm a total loser again through 2000. That's a rough thing to do. I'm probably out of business a couple times during that time. So anyway, you guys have a good week. We have 2 speakers next week. You're working on your projects. If you have any questions, you have 2 choices. You can email me or show up at office